Information that will be reviewed here is for discussion, education, entertainment, and illustrative purposes only, and should not be construed as professional financial advice, solicitation, or recommendation to buy or sell any securities. Thank you for watching this video. I'm going to be going through the Dolla Financial Services prospectus. Now, the company is positioned to open its offer to the public on May 27th, 2022. We had another video where we went through the prospectus, discussed all the areas of it, but I thought I'd do one just going through the financials, just in case you wanted that sort of deep dive into what the numbers said, because we would not have gotten a chance to go through that in that other video. If you missed that other video, I'll link it in the description, and I'll try to link it in the card up above as well. So be sure to check that out whenever you get the chance. So let us kind of talk about an overview of the offer first before I get into the financials. So this is what we would have covered in the prospectus review. I'm only going to focus on points 4 and 5 for this video. So again, if you want the full overview, be sure to check out that video where we went through the prospectus. So I'm going to go straight to just the offer details here, just to give you the overview of what was there. So the prospectus would have been released on May 19th. The opening date is May 27th. The closing date is projected to be June 10th. Now these dates are subject to certain factors. Now, if it is oversubscribed, it may close early. If they're not able to raise the funds in time, it may be extended. Either way, you just have to stay tuned to all the, maybe their social media, the Jamaica Stock Exchange website, to let you know about the details there. The basis of allotment, once closed, will be published within 6 days of the closing date. And then any refunds to be issued will be issued within 10 business days of that closing date. And then the listing of shares on the Jamaica Stock Exchange Junior Market will be within 15 days of the closing date. Just some dates to bear in mind. The ordinary share, the share capital details. Now their authorized shares is unlimited, which means they can issue additional shares at later date if needed. The currently issued shares at the time of this video is 2.25 billion. They're going to be issuing 250 million new shares, and 250 million shares will be made available by selling shareholders. So the total being offered currently is 500 million, comprised of those two buckets that I would have just mentioned. And the offer, well, the total after invitation is set to be 2.5 billion. Again, if they seek to raise more money in the future by issuing more shares, that number is subject to change. So these are the two pools that they would have made available. The reserve pool is 287.5 million, and the sale of sale shares is 212.5 million. And well, these are the two pools rather. Sorry for misspeaking there. In the prospectus review, would have gone through who is eligible, who is available to purchase through those two pools. I'm not going to cover that in this video here. I wanted to speak about this part as well, just to give you a sort of overview here. You're planning to use the proceeds of the offer to expand its loan portfolio through acquisitions, as well as organic growth, and to strengthen its capital base. And the reason why I'm sharing this, of course, because we're going to be looking at the financials, so we'll get some context as to what their existing capital base is in terms of their balance sheet, and then we will look at their profitability later on. The proceeds of the sale shares being sold by selling shareholders will be used to settle existing debt obligations, and we'll look at that in the notes as to what those existing debt obligations are that were assumed on behalf of the company, and these proceeds will accrue to the benefit of the selling shareholders and not the company, which makes sense under the circumstances. Okay. If you would have missed it as well, they mentioned that their dividend policy, if it is that the shares are admitted, they're planning to pursue a dividend policy that projects an annual dividend of up to 50% of net profits available for distribution, subject to the need for reinvestment in the company from time to time. The board of directors may change this dividend policy from time to time as a result of, among other things, changes in the return on equity of the company, its liquidity needs, or material changes in tax policy affecting the business. Now, one thing to understand here is that dividends aren't guaranteed. So just understand that, just note some keywords here. Intend to pursue a dividend policy. That means that's something that they intend to do, they plan to do, but it's subject to the factors that would have been stated here. Okay, hopefully that overview would have been helpful for you. Let me actually bring the prospectus, which is what I'm going to use to go through the financials. Okay, so again, I'm not going to be going through the highlights because we would have done that in another video. So I'm just going to go straight. Well, let me actually start here. Zoom in here. I'm just going to speak about the makeup of the company's interest income, because we're going to be looking at their income over the past 5 years. I'm going to see how that is being made up of here. So on this page of the prospectus, let me see, it's page 17. They have these different products, right? So these are the different products that would have been categorized in terms of the loans that they provide to customer. In short, it's all loans, but they have different flavors of loans depending on the segments that it's being offered to. So the fix up your bar, for example, would be for bar owners. They have one called One and Ready, which is for taximen, Dolla value personal, and they have these different products. Interesting to note here that 80% of their total, the makeup of this is the Dolla Elite and the Dolla value personals, right? So that would account for 80% of the interest income generated. Okay, so that's something to bear in mind. Let me move through here. This is just speaking to the current share standing. This right here is speaking to their material contracts, so the rent being paid, details of the location, etc. So I'm just gonna scroll through to the highlights here. Okay, so everything that we're seeing here on the left, I've actually recorded in Excel. So I'm gonna bring up that Excel document now. So this is what you're seeing on the screen. If you note here, if you're looking at first line 23,196, it's the very same numbers that I've input into Excel. And I've just added this little sparkline chart here so that we can see how that number has been trending over the last 5 years. One thing I noted in going through these financials, that because the last 2 years were essentially a pandemic, you want to bear that in mind when you're looking at these numbers. It's going to mean that you may see either some dramatic change, or that's the expectation. When we go through them, you'll see. You also want to look at, so it may be that you might look at the average for the last 5 years in some instances. That may not apply here because, again, I think because the last 2 years were a unique event, then it would have skewed some of the numbers that otherwise, if we didn't have the pandemic, would have maybe gone a different way. Just wanted to note that. So we see where total income would have gone from 23 million, and these numbers are in millions, 23 million in 2017 to 395 million at the end of 2021. Net interest income, and that's definitely a number we want to keep an eye on. That started at 10 million, ended at 325 million at the end of the last financial year. Operating expense would have rose from 44 million to 153 million. And that would be, you know, as their company would have expanded, new employees, new team members, new investments in terms of what it takes to operate the business would have been undertaken. So that's what that expense is. And net profit before tax, their first year was negative 22 million, has grown to 167 million at the end of 2021. right? In terms of their balance sheet, and we're going to look at this in depth a little later on, but balance sheet started at 96 million in terms of total assets. End of last year would have been 861 million. That's what we're seeing here. And of course, we know assets going to equal to liabilities and equity. So that would explain these two numbers as well. So their liabilities have grown. And of course, because of the type of business, they need capital to be able to provide loans. So I suspect we're going to see some either loans or financing or some sort of debt that they would have taken on to have the capital to do these loans. We're going to be looking at that likely on the balance sheet and in the notes as well to get some context on that. Okay. Total loans we saw was 792 million in 2021. And we saw loan loss provision or expected credit losses. Now this is important, and they've shared the calculation for this based on the type of business and the risk presented. There has to be some provision made for this, right? So this is actually something that you're not going to see for a company that doesn't have the same type of considerations. So it would be maybe one of the other companies we may see this on, maybe like a Cygnus or some other financial type company would have to, verify, but that is what we're seeing here. Cash and cash equivalents would have started at 29 million. That would have grown to 65 million at the end of 2021. And we see the graph here now, there would have been a dip in that for 2020. And again, because of what that year signified, we can understand why this is likely to have occurred. We're going to look further, of course, go through the notes, see what the MD&A says to add some more color to this. But that's what we saw there for 2020. Retained earnings, negative for the first 4 years, but rose to 65 million in 2021. So that we'll look to see what would have accounted for this as well. When we talk about cash flow now, we look at this within context of the company. Cash flow from operating activities last 2 years would have been positive, 46 million and 71 million respectively. Now cash used in investing activities, fairly, the range is between maybe 2.9 million and 4.5 over the last 5 years. So that's been fairly within the same range. Net cash used in financing activities. Now you're likely to see more variations here depending on what they would have gone through, whether dividends have been paid, loans have been acquired, etc. So that's what we're seeing here in terms of net cash used. And again, we'll see more context into this as we go through. Cash and cash equivalents. Again, we looked at this earlier, so no need to repeat it here. And now these financial ratios, now efficiency is definitely one of the things you want to look at, and the lower the number, the better. So efficiency ratio has been going down from 190 5 years ago to 39%. So it's important to look at how this continues to trend. And I'm thinking that maybe within the next year or two, we'll be able to have a little bit more insight as to how it would be performing post-pandemic. Now, of course, we're not sure if the pandemic will actually end because we're at our 5th wave, but we'll see. Net interest margin, definitely want to look at this number as well. Net interest margin, as the name suggests, would have gone from 35% since 2018, would have been above 50%. So that's good to see. 62% ending 2021 is definitely a good sign. Net profit before tax margin, because they'll be listing on the junior market, they actually get a tax break for the first 5 years, and then they get half the normal rate for years 6 to 10. And if they're able to maintain their compliance and their status, then they'll be able to benefit from that, I believe, up to 15 years. Okay, so we're going to see this definitely improve in terms of net profits because they will have less taxes to pay. Just something that I wanted to note here. Return on average asset is 28%. Started out at negative 35%, was positive for 2018, really low for these 2 years. And again, some further analysis would be needed there. And 28% again in 2021. Return on average equity, 103%, had quite a bit turnaround from 2018, where it was negative 405%. So the last 2 years would be, positive in terms of those results. Debt to capital, 61%. Loan loss provision or expected credit losses to total loans, and this would be 5%. Now, one of the things we discussed in the prospectus video, and I recommend that you watch that again if you haven't done so before, is we spoke about these numbers relative to the financial industry. These numbers are considered favorable or positive because of the type of business that Dolla Financial is. Now, you want to always be comparing this to the financial sector, see how other persons in the market, how these numbers vary. I believe some companies in the financial industry like banks, commercial banks, etc., are known to do somewhere maybe between 3 to 5%. So the fact that they are 5% bodes well for them. Okay. So that gives you the context to these numbers that you see on this page. That's what I would have just gone through. So let us kind of speak to now an overview of these numbers that we would have just given the highlights for. So it says here that, despite the pandemic, the group increased its total income to 395 million, and that's a 56% increase over the prior period ended December 2020. And this increase in income is attributable to the launch of innovative products. We spoke about those products before earlier in this video, and that led to increased loan disbursements. So that's what they're saying would have increased to led to an increase in total income, along with access to capital from the capital markets to expand its loan portfolio and their extensive branch network, right? During the 5-year period, they would have seen an average growth rate of 76%. That's what it's commented. That's what it's saying here. And the growth in revenue over the years is explained by an increase in net interest income. That's one of the numbers we looked at previously, which is directly attributable to the increase in funding coupled with sound leadership and revised new product offering. So that explains the growth that they've seen over the past few years in terms of income. And we really want to see how things go for the next few years. All right, this is net interest income. Spoke about that before. Let's see what the highlights say here. So it recorded net interest income before expected credit loss of 325 million in 2021, and that is an increase of 123 million or 61.4% over the prior period. So during the 5-year period, net interest income grew from 10.3 million, we spoke about that before, to 325 million, and that results in a 5-year compounded average growth rate of 99%. Okay. It also says here that there was a decline in net interest margin, and it says there that for 2021 it was 62% relative to 81% the prior period, and 57, 51, and 35% respectively for 2019 to 2017, and that decline is due to the loan book expanding significantly when compared to 2020. So that gives you some context as to what that is. It speaks about the operating expenses, and their operating efficiency has actually improved relative to 72%. As we said, the lower the number, the better in terms of that efficiency ratio. This was a result of significant year-over-year increase in total revenues and a reduction of non-interest expense, with a much lesser proportional increase in operating expenses. And it speaks to them making an effort to create relationships with suppliers to secure optimal pricing, ensuring strong negotiation with vendors, and so on, right? And you're seeing here the profit or loss before taxation per employee from 2017 to 2021. Let's take a look over the other side now. This is a continuation of the operating expenses section, and the seeming reduction in expenses here may be attributed to the differences in the reporting periods for 2020, which in this case is 18 months, right? So when at one point they would have had to adjust their financial year to accommodate the shift in ownership. So it went from July 2020 to the July 2019 to the end of 2020. So that particular period was reporting for 18 months. All right. So the year-over-year comparison for December 2021 relative to December 2020 in the 12-month periods, we're going to discuss that a little later on in this section. Okay. And we see the profit before taxation here would have grown from negative 22.4 to 167.8 million. So that's what we just looked at here in terms of the graph. Let's look at the highlights. The company's net profit before tax margin also increased to 42% in 2021 relative to 7% in 2020. Losses for 2017 and 2019 were driven primarily by increases in expenses, particularly staff costs. And as the company expanded its workforce to better meet the greater demand of its growing operations, right? So that's one of the things that we see them doing. New locations, new employees means increases in costs for that respective line item, right? As at 2019, Dolla's staff complement increased to 24 employees. This represents a 50% increase when compared to 2018, where they had 16 members on staff, right? So as staff complement increases, that line item is going to grow as well. All right, so the growth in profit before taxes has resulted in a significant improvement in the company's return on average equity. We looked at that number from 0 to negative 405%, and it ended as positive 103% at the end of 2020. The negative return on equity in 2018 can be attributed to the shareholders' deficit of 57 or 54.79 million, which was included in the calculation of average equity when combined with the equity position of 37.27 million. Okay. So it says here, nevertheless, over the years, Dolla's access to capital and investments results in a significant improvement in profit before tax, leading to a return on average equity of 103%. What we're seeing here is expected credit losses. We're going to get to that on the other page. And this is as a percentage. So from 0 here, ending at 5.4 at the end of 2021. And we're looking here non-performing loans to gross loan. And this would be here. Now, again, I guess we expect this spike in 2020 to be based on the pandemic. And I believe it would comment on it on the next page. Okay, let's look at, so we spoke about total assets. Love to see that growth there. We'll see the makeup of the balance sheet soon to see what this is comprised of. So expected credit losses here on loan amounts to 42.5 million as of December 2021. We're up 20.4 million over the prior year. Over the 5-year period, ECL to gross loans moved from 0% to 5.36. The ECL movement is directly attributable to the growth in the loan portfolio, as well as additional provisions based on the revised assumptions incorporated into the impairment methodology due to the global COVID-19 pandemic. And they have a calculation in the notes to show what goes into this calculation. So non-performing loans to gross loans move from 7.4% to 5.26% over the 5-year period, with a spike in 2020 driven by the COVID-19 pandemic. We spoke about that before. So of course, what that means is that which caused reduced operations in several key economic sectors and affected some of their clients' ability to honor their repayment obligations in a timely manner. Again, this is one of the risks you have to consider for this type of business. It comes with the territory, so there has to be some appreciation of the fact that there may be this loss that is incurred, And in some cases, it may not be a loss. It could just be delays in terms of receivables, or maybe refinancing opportunities, which ultimately may lead to more profit for the company. The significant reduction in non-performing loans in 2021 was led by the growth in loan portfolio from 58 million to 750 million, or 1,075%. This is followed by the implementation of a customer assistance program, or CAP. This is either maybe a moratorium or refinancing or something that they have extended to their customers who were negatively affected by the pandemic, an opportunity to refinance their existing loans, right? That's pretty much what we said. Management's reinforcement of a culture of a strong and innovative risk management and governance strategies has positioned the company well to support its clients and effectively manage the non-performing loans over the period. Dolla has also been able to contain NPLs by diversifying its borrowers across industries and credit types, limiting exposure to any single borrower, placing emphasis on secured loans. And there's actually a makeup of that. Let me see if I can locate it. They spoke to here. So they have their classification, business versus personal loans here. So you have unsecured business loans, that's represents 3%. You have secured personal loans, that means there's some form of collateral or security being offered. Unsecured personal loans account for 30%, and secured business loans account for 64%. The only consideration that I would probably have here is that you want to now think about maybe how these loans are secured. Just because it's secured doesn't mean that you're going to be able to get full value now, depending on the asset being used. If the person defaults, then let's say that land was used, then maybe you'll need to now go through the process of trying to sell that land to recover your money. That may take delays, that may have certain costs, but it's good to know this makeup, because it means at least risk is going to be limited based on the areas that are secured versus unsecured. And on the previous page, what we see here is the breakdown per industry. So we're seeing here the largest industry is manufacturing. No, largest is 22%. So that's 139 million, and that is trucking, haulage, and transportation. Then we have construction. Then we have manufacturing. So those are the three largest segments for them, and then it breaks it down from there. So this speaks to the industries that their loans are distributed to. So that's important to understand based on their current loan portfolio. And there's also another breakdown here. Let me see the loan portfolio, because that's pretty much on that page already anyway. So loan portfolio growth. So based on the different products that they're offering, the fact that they would have, sought to take advantage of opportunities to scale with different industries that are positioned to do well in the pandemic, would have seen that growth in their loan portfolio. So that's definitely good growth to go from 58 million all the way to 750. Now it's important to look here as the growth of the portfolio in comparison to some of these that we would have shown here in terms of return on asset and equity. For example, the net interest margin based on the amount. So if you take this line and you compare that to what you're seeing here, so with a portfolio growth or loan portfolio of 421 million, they would have done 51% net interest margin, and with 750 million, they would have done 62% here. So you want to put that into that context, right? So we're reading through here. Let me get back to where we were before. All right, so management's reinforcement, I think I read that already. Our collection team. So this was something that stood out to me. You want to pay attention to this area Our collections team has been working assiduously to increase the rate of collections with difficult accounts and have reported a recovery rate of 95% on defaults. Now, loans have to be outstanding for a certain time before it gets to a default status. For those who have gotten to that status, they've collected 95% of those defaults, which again is a pretty good number, I'm imagining, based on what the industry may do. And they're saying here through analysis on customer behavior patterns and expansion, their aim is to increase the recovery rate by an additional 1% in the coming year. So they're hoping to recover even more of the money that has been outstanding for them. Okay, this is speaking to the loan portfolio here. These industries included BPO and outsourcing, haulage and construction and manufacturing. We saw that breakdown earlier. The company raised $200 million through a private placement funding and a further $101 million loan from L.E.A.R.N Trading. That would have explained their ability to be able to grow their loan portfolio, what we would have shown earlier, from which net proceeds were used to support loan growth. So this would have explained how they were able to go from a certain amount to 750 million. So with the introduction of a new and innovative suite of products, they were tailored to their clients' needs. The demand for loans also increased during the period, and they've seen that growth rate of 66% per year. And they dispersed 1.03 billion in funds to its customers, and an increase of 563 million over the corresponding period for the previous year. Okay. It says here, Dolla maintains a well-diversified loan portfolio in relation to its sector concentration, ratio of business to personal loans, as well as secured to unsecured loans. This has allowed the company to reduce on average the credit risk of the loan portfolio in relation to sector diversification. The company has placed emphasis on creating value for customers in real sectors such as construction, which makes up 18%, manufacturing, trucking and haulage, which is 22% as we saw, with the average loan size of 400K, which has been strong performance despite the pandemic. Important to note here because that gives you some context as to what the average loan size would have been made up, right? So I'm actually gonna just highlight that for my own benefit so I can go back to that at a later date. Okay. All right, and we looked at that overview already. All right, let us see here. So this is speaking to the income statement, the balance sheet. So this is going through the ratios now just for the last 2 years. What I actually want to do here is go straight to the outlook. So let me increase here. We're gonna go with credit quality because that's the thing that we want to watch the most here based on the type of company. So for the 3 months to March 2022, the expected credit losses on loans amounted to 47.3 million as at March 22, and we're up 22 million over the corresponding period for 2021. Overall, the ECL reduced from 7% to 5.16% as at March 2022. So that's a good thing to see there. This is an indication of the quality of their loan portfolio remains strong. Non-performing loans as at the 3 months ended remain at a manageable level. These loans represent 5.14%, a reduction from 7.59%. And okay, that's just speaking to their strategies there. The company's asset base increased over the period by 575 million to 934 million as at March 31st. This was predominantly as a result of growth in their loan portfolio, which grew from 325 million as at March 2021 to 870 million as at March 30, 2022. Okay, so that's definitely some good insights. Let us actually go back over this side to see what it's saying about income and revenues for the quarter. Right, because what we're seeing here is that they're speaking to the first quarter of 2022. Definitely something that you want to hone in on. The Company continued to demonstrate its positive performance for the quarter ending March 31st, with total revenues of 141 million compared to the prior corresponding period of 64.2 million. This represents an increase of 72 million or 120%. The increase in total revenues is attributed to the continued expansion of the company's loan portfolio, which grew from 325 million to 870 million as of March 31st. During the quarter, the company continued to build momentum in loan disbursements by deepening its customer connection in existing markets. The company's product suite continues to be an effective solution to the needs of individuals and businesses, both locally and regionally. And what we mentioned in the prospectus video, they have an operation in Guyana that they started in August 2021, and they're seeking to build that out, which currently represents about 2% overall income that they realize currently. So the net profit before taxation growing from 27% to 47% for the quarter ending March 31st. Definitely good to see there. Operating expenses increased from 27 million to 64 million, primarily as a result of increased staff costs. Again, as they are growing and expanding the company, you're going to see that. Their efficiency ratio was 45% compared to 58% for the comparative period previously. And Jamaica reported 127 million in total revenues, and Guyana reported 13.9 million. And as it relates to operating expenses, Jamaica stood at 58.9 million and Guyana reported 5.2 million. So the net profit stood at 60 million for Jamaica and 5.5 million for Guyana, respectively. So that's what they would have done for the first quarter of 2022. Okay. So let's talk about outlook and strategy. Let's see what they have to say about that. Sorry that if the Zoom gets a little challenging for you. It's just unfortunately how these documents are structured. I really wish it was just like one smooth thing we can just read through, but Dolla believes there's significant growth potential in Jamaica and the Caribbean for short-term personal and microloans to retail consumers and businesses, respectively reaching a total of 900 million in the next 5 years. So that is their projection. The company will continue to strategically expand its branch network locally and regionally to increase footprint, customer base, and market share. So that is their aim over the next 5 years. Making our products and services more accessible to their valued customers. Management also intends to pursue new strategic partnerships with financiers, suppliers, and customers that will grow its business line and customer base. In the short term, the company will also prioritize the enhancement of its delivery channels and improve its customer experience through investment in technology. So this is speak to mobile applications, maybe allowing persons to apply for loans through an app, working on social media to reduce the gap between how they can reach out to customers, etc. So it's speaking about technology improvements there. And it ends by saying Dolla is confident that it is strategically positioned to weather the storms that are currently being faced by the pandemic. And we spoke about the tax break that they're going to be receiving. That's something that you will see reflected on their statement once listed. And it's speaking to Dolla Guyana Inc. Let's quickly see what's happening there. I believe it's just speaking to what they're seeing in terms of outlook for that country. And I think I can bet it's gonna say that it's looking to be favorable. Okay. So this now speaks to their financial statements ending 2021. I said I wanted us to have just a glance through these notes. So I'm not gonna go through everything in detail. I'm trying to wrap this video up in hopefully a few minutes. So I'm just gonna go to some very specific things. We would have gone through an overview of the financials, spoken about the highlights, gone through the MD&A. So I just want to see now how certain things would have been now looking based on the fact that we saw highlights and not, the numbers for 2020 and 2021. Okay, so cash and cash equivalents as at the last, financial year would have ended at 65 million. Would have seen that. Loans, net provisions for credit losses, 750 million. Other receivables, we'll get to see what that is in note 8. We'll see the loans broken down in note 7. We'll get to those soon. Property, plant, and equipment is 36 million. That's not going to be a large number based on the type of business that we have. This was a part that we wanted to take a look at now because of how they finance their business, right? The liabilities. So payables and accruals, 17 million, that would have increased from 10 million in 2020. Taxation payable would have stood at 29 million. Now that number we know is going to be zero once listed for the first 5 years. Loans payable, now this is money that they have to repay, 455 million. We'll see a breakdown of that in note 12. So we're going to look at notes 7, notes 8, and notes 12 so far. Just going to make a note of that so we can go through them. Let me just make a quick note here. 7, 8, and 12. Okay. And lease liabilities, that they would have shown a breakdown of their different lease commitments and things that they have to pay. Share capital would have seen gone from 63 million here to 240 million. You're going to see this number updated again because they're now going to be listed. Retained earnings, this is where they would be hoping to pay dividends from, so you want to look at this number closely. Currently 65 million as at the last financial year. So if they're looking to pay up to 50% in dividends, then you want to divide this number in terms of net profit by the 2.5 billion shares that are going to be outstanding, and that may give you a general idea of what the dividend is shaping up to be. So that's something that you want to look out for. So let's move forward. This is interest income. So this is for the 18 months ended December 20, and this will be for 1 year, so bear this in mind. So for 18 months, 245 million in interest income, and for just 12 months, 379. So that would be a significant improvement. Interest expense, just by a quick math, you'd see that would be definitely a higher net interest income percentage. That's what would have seen on the summary. Provision for expected credit losses, that has to be there again based on the type of business. Net interest income after loan impairment being 305 million. Fees, foreign exchange losses would have brought that now to 321 million. So fees and other income added to that, but exchange losses, $33,000. Administrative expense, that's their staff, team members, etc. Other administrative costs. Income tax, as we said, that number is not going to be there for the next 5 years, assuming that everything goes as planned for them. So net profit would have risen to 129 million here. Other comprehensive income. So one of the questions that we were asked is, why that drastic number in terms of EPS? Bear in mind that the company had significantly less shares at this point, so the EPS would certainly be, a high number. But of course, now with the number of shares outstanding being greater, it's going to take, a lot to generate an EPS that is anywhere to this level. So you want to set those expectations and projections based on the number of shares that are going to be outstanding moving forward. But it does show an EPS calculation later on. Okay. All right, so let's look for certain notes. We're not going to, let's look through the cash flow statement. So cash used in operations here, 571 million as opposed to the previous year. And notable increases in that, loans receivable would have been here, interest income, 379 million. Net profit, though greater, there were more things to consider in terms of outflows in terms of operations, which would have led to a higher cash used in operations as opposed to 2020. Interest paid, again, with these expenses are going to be as a result of just the payments and so that they would need to make. So interest received, that'll be 353 million. Loan received, 351 million here. Loan interest repaid. So anything that you see in a bracket is a payment or outflow. Anything that's positive is funds coming in, right? So that's net cash provided by operating activities, 71 million here as opposed to 46 million in 2020. Okay. Investing activities, not much to report here in terms of property, plant, and equipment, 2.3 million. And then financing activities due to parent company, those are blank for 2021, but they had payments the year before. Lease principal payment, 7.1 million. In terms of cash and cash equivalents for the year, we see that at 65 million. Would have seen that here as well. Cash and cash equivalents would have been 65 million. Okay. So let's check out the notes now. I think that's where we want to go to get some more insight now. If you want to see, overview of the company, how they're constructed, etc. This page that I'm on speaks to identification of principal activities. That's something to know. That's item 1. We said we'd go to 7, 8, and 12. So those are the notes we're gonna go to. But I'm scrolling through slowly just in case there's anything else worth mentioning here. They do show segment information here, breaking down Jamaica and Guyana. I think that's worth looking at if you have the opportunity. Okay, so I said we'd look at item 7. So this is loans, net provision for credit losses. So this is what we're seeing here, and they'll speak to the calculation of the ECL, I believe, on a subsequent page. Okay. So we see for the group, we're going to focus on that one. Gross loans and advances, 750 million. Loan interest on other receivables. So the total was 792 million here. Less expected credit losses, 42 million, resulting in 750 million. Gross loans and advances, 559 million. Less ECL there, giving us a total of 554 million. Okay. This is one of them that we said we'd look at. Provision for expected credit losses at the beginning of the year, provided for during the year. And that's what we're seeing here. Certain loan balances have been pledged as collateral for the 10 million secured loan. That's note 12. That's one of the last ones that we're going to look at. In terms of other receivables now, we said we wanted to look at that item. So let's do that. Other receivables. So staff advance, sundry receivables, prepayments, and security deposits would have made up this $8 million figure there. Investments in subsidiaries, intangible assets, property, plant, and equipment, long-term loans. Okay, this is what we wanted to see.